Every time someone lands at Heathrow, buys a coffee in the terminal, parks a car in the multi-story lot, or shuffles through security past a duty-free shop, a fraction of that money flows into a web of holding companies that traces back to an attic office in Madrid and a Spanish civil engineer who spent a summer in Germany buying railway machinery with the equivalent of roughly 6,000 euros in today's terms. Heathrow is the busiest airport in Europe. In 2024, it handled 83.9 million passengers, surpassing its pre-pandemic peak. It sits at the center of one of the most leveraged, most scrutinized, and most contested ownership structures in modern infrastructure. And the family most responsible for that structure is a Spanish dynasty called the Del Pinos, who built their fortune on train tracks before quietly acquiring the airports that hundreds of millions of people walk through every year. Most people have never heard their name. Rafael del Pino y Moreno was born in Madrid in 1920. He trained as a civil engineer and worked in construction before leaving his employer in 1952 to start something of his own. That summer, he traveled across Europe, studying how other countries built their railway infrastructure. In Germany, he bought machinery for the equivalent of roughly 6,000 euros in today's terms, loaded it up, and brought it back to Spain. On December 18, 1952, he founded a company in an attic near the Jerónimos Church in central Madrid and called it Ferrovial, from the Spanish word for railroad. The name was accurate. Ferrovial's first contract was to supply and install wooden rail sleepers for Renfe, the Spanish national railway company. These are the rectangular beams that sit beneath the rails, holding them evenly spaced and upright. In 1954, the company landed its first international project, a railway job in Venezuela. 2 years after that, it renovated the rail line between Bilbao and Portugalete. The work was straightforward and physical, and it gave Del Pino y Moreno a reputation for reliability. Spain in the 1950s was still under the Franco dictatorship, and the national economy was only beginning to recover from the devastation of the Civil War. The government was the primary client for large infrastructure, and Del Pino knew how to navigate those relationships. His political connections helped Ferrovial win a string of contracts through the decade. He gradually bought out other family members who had initially held shares, and by the start of the 1960s, he owned it entirely. The 1960s brought a construction boom. Spain expanded its road network under the Redia Plan, a national highway program, and Ferrovial moved into road building. In 1968, it won the concession for the Bilbao-Behobia Highway, the first toll road in Spain financed and managed privately. That was a turning point. It introduced Del Pino y Moreno to the concession model, where a company builds and operates infrastructure for decades and collects revenue from users rather than simply building and handing it over. The recurring income was more stable than construction contracts and grew predictably as traffic increased. Spain hit economic turbulence in the 1970s following the global oil crises. Ferrovial responded by looking abroad. The company built 700 kilometers of roads in Libya under the Gaddafi government, a project running from the late 1970s into 1986. It also won contracts in Mexico, Paraguay, and Kuwait. Del Pino y Moreno's nickname in Spain was El Rey de los Ladrillos, the King of Bricks. His son, Rafael del Pino Calvo Sotelo, was born on July 14, 1958, the eldest of 5 children. His mother was Ana Maria Calvo Sotelo, whose brother Leopoldo Calvo Sotelo served briefly as Prime Minister of Spain in 1981. The younger Rafael studied civil engineering at the Polytechnic University of Madrid, graduating in 1981, and immediately joined the family company. His first assignment was not in a Madrid office. He was sent to Libya to work on the road construction project his father had started, overseeing hundreds of kilometers of highway in the desert. In 1984, he went to Boston and enrolled at MIT's Sloan School of Management, earning an MBA in 1986. He returned to Ferrovial and rose quickly through its management structure. In 1992, at the age of 34, he was named CEO. The 1990s were transformative. Spain joined the European community and began modernizing its infrastructure at speed. Ferrovial built part of the high-speed rail line between Madrid and Seville, won construction contracts for the 1992 Barcelona Olympics, and built the Frank Gehry-designed Guggenheim Museum in Bilbao. In 1995, the company acquired Agraman, one of Spain's largest construction firms, making Ferrovial one of the biggest builders in the country. In 1999, it won a 99-year concession to operate the 407 ETR toll highway across northern Toronto, its entry into the North American market. That same year, Ferrovial went public on the Madrid Stock Exchange. In 2000, the founder stepped down after 48 years. He handed control to his eldest son and spent his remaining years on philanthropy through the Rafael del Pino Foundation. He died in June 2008 at 87, 4 years after an accident at sea left him partially paralyzed. By then, his son had already pulled off the biggest deal in the company's history. In 2003, the British government removed its so-called golden share in BAA plc, the privatized company that had owned and operated Britain's major airports since 1987. The golden share had allowed the government to block foreign takeovers. With it gone, BAA was fully exposed to the market. BAA was, at that point, widely described at the time as the largest commercial airport operator in the world. It owns 7 airports in the United Kingdom: Heathrow, Gatwick, Stansted, Glasgow, Edinburgh, Aberdeen, and Southampton. Together, those airports handled around 63% of all passengers flying in and out of the country. Heathrow was the crown of it all, serving more than 80 airlines and connecting to over 180 destinations in more than 90 countries. Its retail space generated hundreds of millions of pounds a year. Airlines had to use it because there was nowhere else to go at the same scale. As one Deutsche Bank analyst put it at the time, airports like that are somewhat natural monopolies. Ferrovial began studying BAA quietly. In February 2006, it made an initial offer of 810 pence per share. BAA's board rejected the bid as too low. Ferrovial came back in June with a revised offer of 950.25 pence per share. A rival consortium led by Goldman Sachs offered slightly more at 955.25 pence. But BAA's board preferred Ferrovial's bid because it was further along on regulatory approval and gave shareholders the option to receive shares rather than only cash. On June 6, 2006, BAA accepted. The total price was £10.3 billion. Ferrovial led the deal alongside 3 partners: Caisse de dépôt et placement du Québec, Singapore's GIC Special Investments, and Macquarie Bank of Australia. The deal was financed heavily with borrowed money. The consortium put in approximately £4.6 billion in equity. The rest came from debt. By the end of 2006, liabilities across the various holding entities within its leveraged acquisition structure had reached £13.5 billion. BAA, which had previously carried £7.9 billion in liabilities, saw that figure jump to £16.6 billion in 2007. Annual interest payments went from £153 million to £773 million in a single year. The company swung from a pre-tax profit of £757 million to a pre-tax loss of £106 million. BAA was delisted from the London Stock Exchange in August 2006. Almost immediately, the problems started. Before we move on, if you're enjoying this analysis, please consider subscribing. It helps the channel tremendously. In the summer of 2006, the UK government introduced sweeping new security measures at airports in response to a foiled terrorism plot. Heathrow was overwhelmed. Queues ran for hours. Passengers stood in tents outside terminals. Luggage was lost at enormous scale. The media turned on BAA with a ferocity that continued for years. Willie Walsh, then chief executive of British Airways, said publicly the situation could not continue. Ferrovial's chairman eventually admitted Heathrow had many deficiencies. Critics pointed to the heavy debt from the takeover as the reason investment in passenger infrastructure had lagged behind the retail expansion. The airport was accused of prioritizing shops and concessions over the people trying to catch flights. In June 2006, the UK Office of Fair Trading had already launched a market study of British airports, triggered by complaints from airlines and passenger groups about rising charges and declining service. The study led to a formal Competition Commission investigation. The Commission's conclusion in March 2009 was sharp. BAA's common ownership of competing airports across London and Scotland was creating adverse effects for both passengers and airlines. Glasgow and Edinburgh, owned by the same company, had no incentive to compete with each other for airline business. The Commission concluded that BAA lacked incentives to invest efficiently and had no effective long-term strategy under common ownership. The order came down. BAA had to sell Gatwick, Stansted, and either Edinburgh or Glasgow, all within 2 years. BAA fought the ruling through every court it could find. It lost at the Competition Appeal Tribunal. It lost at the Court of Appeal. In November 2011, the Supreme Court declined to hear its appeal. BAA had lost at every level. Gatwick sold to Global Infrastructure Partners in December 2009 for £1.51 billion, around £300 to £500 million below what BAA had hoped to receive before the financial crisis hit. Ferrovial later confirmed a capital loss of approximately €142 million on the sale. Edinburgh followed in 2012 for £807 million. Stansted went to Manchester Airports Group in 2013 for £1.5 billion. Then, still carrying heavy debt, BAA sold Aberdeen, Glasgow, and Southampton to a consortium of Ferrovial and Macquarie Group for £1 billion in 2014. BAA had held 7 airports. By 2014, it held 1. It renamed itself Heathrow Airport Holdings. All the revenue, all the debt, all the regulatory scrutiny, everything concentrated on a single facility in West London. The debt that remained was enormous. At the height of the COVID-19 pandemic in 2020, with passenger numbers having collapsed from 80 million to a fraction of that in a single year, Heathrow Airport Holdings carried over £17 billion in debt to banks and bondholders across the various holding entities within its leveraged acquisition structure. The airport applied to the Civil Aviation Authority to raise its passenger charges. The CAA rejected the request. Heathrow was described at the time as among the most heavily indebted companies in the United Kingdom, with the vast majority of its shares held by overseas sovereign wealth funds and institutional investors. Ferrovial had been gradually selling its stake for years. In 2012, it sold 10.6% of the airport's parent company to Qatar Holding for €607 million. That same year, it sold a further 5.72% to a subsidiary of China's sovereign wealth fund for £257 million. Each sale cut its ownership, but left it as the largest single shareholder. Then, in January 2024, Ferrovial announced it would sell its remaining 19.75% stake. The buyers were Ardian, a French private investment firm, and Saudi Arabia's Public Investment Fund. The transaction completed on December 15, 2024, with Ardian acquiring 22.6% and the Saudi fund acquiring 15%, together paying $4.12 billion. Following the transaction and stake consolidation, Ardian's total holding rose to 32.61%, making it Heathrow's largest single shareholder. Heathrow today is owned by a consortium led by Ardian at 32.61%, Qatar Investment Authority at 20%, Saudi Arabia's Public Investment Fund at 15.01%, Singapore's GIC at 11.20%, Australia's Retirement Trust at 11.18%, and China's Investment Corporation at 10%. The Del Pino family, through Ferrovial, no longer holds a stake, but the family's airport story did not end there. Ferrovial retains 50% stakes in Aberdeen, Glasgow, and Southampton through the AGS Airports Consortium. It holds a stake in Dalaman Airport in Turkey, and in 2022, it agreed to acquire a stake in the new Terminal 1 at JFK International Airport in New York, a $9.5 billion project that will replace 3 of JFK's existing terminals and create a facility of more than 2.5 million square feet, with a lease running to 2060. Ferrovial's investment in the JFK terminal was approximately $1.14 billion. While all of this was happening at the corporate level, the family itself was coming apart. When the founder died in 2008, he left 5 children as heirs to a stake in a company worth billions: Rafael, Leopoldo, Maria, Joaquin, and Fernando. For a time, they voted together. The alliance collapsed in 2015 when the family broke its formal shareholding agreement and split the stake between the siblings. Fernando had already left the family office in the 2000s to create his own investment firm and no longer holds Ferrovial shares. Joaquin resigned from the board in 2019. Leopoldo, who holds approximately 4.2% of the company, opposed Rafael's plan to relocate Ferrovial's headquarters to the Netherlands and threatened to vote against it. By 2023, only Rafael and Maria remained on Ferrovial's board. The move to the Netherlands went ahead anyway. In May 2024, Ferrovial began trading on the Nasdaq, becoming the first major Spanish IBEX 35 company to list its ordinary shares on the US exchange. Spanish Prime Minister Pedro Sanchez criticized Rafael publicly, saying there are businessmen committed to Spain, but this is not the case of Mr. Del Pino. Rafael Del Pino Calvo Sotelo controls approximately 21.3% of Ferrovial through his personal investment vehicle, Ryan Capital, based in Luxembourg. His net worth as of late 2025 was estimated at around $10 billion, primarily from his Ferrovial stake. The company's revenue in 2024 was 9.1 billion euros. In May 2022, the British government awarded Rafael an honorary Commander of the Order of the British Empire for services to UK transport infrastructure. Heathrow's revenues in 2024 were £3.6 billion. For the first time in 5 years, its board declared a dividend of £250 million to be paid to its ultimate shareholders, the sovereign wealth funds of Qatar, Saudi Arabia, Singapore, and China, along with Ardian and Australia's pension fund. A man who started in a sloped attic in Madrid with borrowed machinery and a contract to cut wooden railway sleepers. A son who learned the business in a Libyan desert. A family that built Spain's roads and railways, then flew past all of it to end up controlling the airport at the center of how Europe connects to the rest of the world. And then, quietly, they sold it.